Hey, everybody, welcome back to another episode of MISMO Mic'd Up. This is a super special episode. It's going to be really special for the audience because you're not going to have to listen to me for the most part. But I'm going to have a guest host today, Eric Lapin, my longtime friend. Eric is going to run the host seat for today's MISMO Mic'd Up, and we're joined by Courtney Brown. And just to level set for you, the audience, and for Eric and Courtney, we're going to talk a lot about blockchain, and we're going to attempt to connect the dots to blockchain and in mortgage, and specifically mortgage in the US. And I'm ignorant on the topic. This is like one of my areas of weakness. And so I'm excited to listen and learn. I hope the audience is excited to listen and learn. And you may even hear a dumb question or two from me along the way. I'm doing that for you, audience. I'm asking the questions that you can't on this podcast. So anyway, Eric, thanks for jumping in and co-hosting. And Courtney, thanks for joining us this morning.
Thanks, Brian.
Absolutely.
Yes. So Courtney, today we're talking about one of the most talked about shifts in financial services. You've been around the business for quite a while. It would be very helpful for the audience for you to talk about, where you've been. You've been right in the middle of this for many years. You actually were in the mortgage industry for a little while, and then you went to Roofstock on Chain, you went to Plume, and now you're building something with the wallet. Very interesting background. There aren't many people that have made that transition and made it successfully and really bring a lot of learning and education and information to the audience. So why don't you start with that? Tell us about yourself, what you did, where you are today. How does this all tie in?
Yeah. It's been a long journey. At times I've wondered why I'm still here and what I'm doing, but it's been mostly fun. So my career started, I actually started working at a small family office as a receptionist, worked my way up to loan processor. This was one of the first jobs I ever had. Quickly moved over to Quicken Loans. I ran their underwriting desk for a few years over there. The market crashed 2008. I thought, wow, this is a great time for me to get my real estate license. I wanted to be out in the field, not behind a desk. So did the first time home buyers, was completely burnt out on that. And then I moved along to different asset classes, commercial, multifamily, hotels. Another kind of like pivotal, monumental time was when COVID hit. I found myself looking for a position to keep a pulse on the real estate market, but obviously we're all stuck at home. So I stumbled upon Roofstock. And the stars somewhat aligned from this because this really, really catapulted my career into blockchain. So I came onto Roofstock. I was managing their retail transaction marketplace, which was basically anyone looking for a home across the globally, I guess I should say, can invest in single family US real estate. This was a very retail facing product, and to be quite honest, didn't make a ton of money at Roofstock. So we decided to sunset that business line. I was absorbed onto another team that focused on blockchain. So our mission here was, how do we sell our product, a single family US home, via the blockchain? This question was probably about a year and a half to find the solution. At the time, you're thinking of securities. We Roofstock is still a pre-IPO company, so we had to protect the pre-IPO business. We were a very Web3 people. Whenever we spoke, they were,
Give us the Luddite version.
Well, it was very much like, hey, we think it's really cool what you guys are doing, but we have no idea what you're talking about. I remember one of my first offsites. I wish I had my notepad because I was writing like NFT, DAOs, all these acronyms, which now I completely understand like at the back of my hand, but it's a different language over there. So ultimately, we spent months and months with legal team. How can we do this? We successfully sold 4 homes via the blockchain with an ERC 721 standard, which is NFT standard.
Ethereum.
This was before the buzzword RWA, so it really catapulted myself personally, my career into boom, here we are. Here I am in the epicenter of blockchain, and now we have RWAs as a buzzword. Shortly after that, I joined an actual blockchain, Plume, that their sole focus was to make RWAs feel more like crypto native tokens. So this was adding lending features, staking features, borrowing features, just kind of having that token that is more historically a piece in someone's wallet that doesn't have much movement, giving it the movement to feel more like a crypto native token. So I was there, launched with their mainnet, went through their Series A, very super exciting over there. It was a really exciting time. A lot of work, crazy hours, and now I lead growth at a vault infrastructure team. So we're basically adding, or we're bringing additional logic and infrastructure to vaults that sit within the Web3 ecosystem right now.
That's great. Back to tokenization piece of it. So for the audience, one of the main questions that I get and others have seen, the other questions I've seen in panels, what happens to that ownership of that asset? That's question number one. And number two, what does this do to liquidity for housing?
Yeah. So tokenization in itself, tokenization is just basically creating a token that mimics whatever that asset is, and you can transfer ownership via that token. So if you own a share of something, you can sell, instead of going through intermediaries, you can take that token, add someone's wallet address, and transfer that token over to someone else by no means other than yourselves. The ownership goes with the metadata, the smart contract executes, the ownership goes to that person that you are intending to send it to. Excuse me, send it to.
Right? Like an ETF or mutual fund. It's a
correct.
portion of the share of an asset. Okay.
I will say though that there is a lot of like regulatory right now. We're still in this gray area where if some of these, there's a term called whitelisting. So if you're a non-accredited investor, you're probably not going to be able to have that token transferred over to you, and that is just to keep the consumers safe over here. So there's KYC, whitelisting of addresses. So in theory, when I say you can transfer it and it goes to its intended user, yes, it does. But there are like regulatory guardrails up right now to protect people from sending, I don't know, $1 million worth of Bitcoin to someone somewhere that you don't want to send it to.
A Saudi prince.
Exactly. And then in terms of liquidity, this is something that this is actually a really big conversation in terms of liquidity. One of the biggest misconceptions that I see in this industry is that if you tokenize something, it becomes, you bring liquidity to the asset, and that is just not the case. Tokenization is the infrastructure by which this asset now moves. The liquidity, if it's an illiquid asset in Web 2, it's probably still going to remain an illiquid asset in Web 3.
But if there is liquidity that's trapped in a best way to say it, it's not easily moved like cash, for example, right?
Correct.
Or even like the USDC for a stable coin. That's liquidity that moves easily. Real estate is not. You've got to go get a loan. You got to do a cash out refi. You've got to get a HELOC. Then you get the liquidity out. So tie us into a quick 2-sentence definition on what is Web 2 and a quick 2 definition of what is Web 3. What's that jump? What's the
my gosh, this is a on the spot here.
Questions, but
Web 2, the way that I would consider it is like Web 2 is the internet as we know it right now. So you go to your websites, you sign in through your email, your password, you do all your stuff that you're going to do. It's very much you lose your password, you email them, you request a new one. Web 3 is kind of like are in the wild, wild west at your own helm of if you lose your password, you're not going to have someone sending you a way to update it. But you also have this beauty of control. So you have, it basically gives the control back to yourself. You do have the optionality to do a lot of tasks or whatever it may be within the Web3 world that just don't exist in Web2. With tokens. So buying T-bills, buying them at a smaller fraction than you would, buying private credit, buying tokenized real estate or fractions of real estate, real estate. All of these things are enabled on Web3 that don't exist in Web2.
I want to double click on the housing and the tokenization, right? So I'm sitting in my home office in my home in Novi, Michigan. And in my mind, when I hear tokenization specific to this asset, this home, I'm thinking about all the data points that reflect this physical property. Is that part of the concept of tokenization, or what creates the token as it relates to this physical asset, this home I'm in?
Yeah. So generally speaking, the way that we did this at Roofstock was that we would tokenize ownership of the house. So it wasn't like the brick and mortar house is what's tokenized. That is a complexity layer that's being added into these tokens within the data, and you call them metadata. So we have this theory of like a dynamic NFT. So let's say, and this is the really cool and interesting part. So let's say that you have a home inspection, you put that within your metadata, it's immutable, anyone can look at it. But the way that it sits right now, you put the home in a trust, in an LLC, and that document is what is actually tokenized versus the brick and mortar home itself.
Yeah, so LLC and or SPV, right? Special purpose
Correct.
vehicle. And that's how this that's a common question that gets asked. Yeah, and tokenized real estate is supposed to be or the projection is 30 trillion by 2035. And housing being a large piece of that. As the tokenization is created as a form of liquidity for an asset that has liquidity options, what is this? It sits on a blockchain, but does that eliminate the bad data or the poor underwriting decisions that goes in there? And does that replace current legal framework that we have today?
Yeah, I would say that it absolutely has a means. Like you have these underprivileged, underserved communities that get glanced over just because of the area code which they reside in. Blockchain absolutely eliminates that. It's more so of putting your data within an aggregate so that people can streamline and process these transactions. So it's no longer looking at as, again, someone that lives within an area code. There's also a further complexity of the way that we look at payments now. So let's say that you like FICO, for an example. We can all agree and disagree on whether we like the FICO scoring model or whether we don't, but there's a way that blockchain can take that data, and let's say that a lender is looking for someone that's like a little bit more risk adverse or someone that does have a riskier profile. You can go to a granular level than just a score, where it gives you those data sets and those points that people are looking for, again, at that granular level, other than just a sheer pass through based on a number.
That's right. And that's where.
Can I ask a follow-up question on that? Using FICO as a specific, reference point. So my FICO score changes, conceivably it changes daily, but let's just say for argument's sake, it's updating every 30 days through the model. I know it's even more frequent than that. How do you think about data that is dynamic and updates on a regular basis? Is it more like an append? Do you append updates to kind of the original source data?
So think about it as I'm going to try and like humanize this the best way I can. So in the crypto world, we've seen, like from 2011 to where we are now, you have these, I'm going to call them crypto degens. That's their name within Web3. They are watching tickers of all of these tokens every second, looking for arbitrage opportunities. The speed of which data comes on chain is not the issue. It's the issue of how people can consume it. So those data points that you're looking for in terms of how often we check and how often they come on board, that's not the issue. It's more so, how do we put that into an algorithm or a model that makes sense for both parties? But it's not necessarily, the blockchain can handle the speed at which you want it to update. It's just more so finding out on the other side what that looks like.
And to your question, Brian, and where Courtney, I think, was going with this is, FICO is globally recognized. We know it in the United States as a kind of a base level of, all right, we know that how we can price this loan based on a score that's been around for 3 decades and continually accepted by capital markets as trust. So think of it as the bedrock layer of determining risk and ability to pay. And Brian and I know this business pretty well on the alternative side with cash flow and alternative credit and data. Brian was running a company called FinLocker that was really digging into the top of the funnel cash flow, kind of similar to where I was prior when we were talking last, Courtney. And I think that as things have evolved with consumers, the way that they generate income, generate cash, there's also other signals that come back saying there's all behaviors. There's behaviors of cash flow. There's behavior of how you handle credit. There's also how does that consumer look at or how they being viewed as a risk. And really, as of date, there's other companies such as VantageScore that has now been accepted in the mortgage market, appointed by FHFA, which is the regulator. But there's still some testing that needs to go on, and there has to be trust from the secondary market on how to price those out effectively. And that's, I don't know if you've kept up with that stuff while you're in Balboa, Spain there, but it's changed a little bit since you've been in it. But I think, we're seeing, when you see the competition, you're going to see a better, stronger muscle that's created in an analytic that really protects the market and keeps liquidity coming. Once that liquidity is opened up, then you have, like you said, for those consumers or borrowers, there's 45 to 50 million people that have low or thin file scoring that can't get loans or have a tough time getting loans. So this opens up different loan products. On the crypto part, back to what you were saying, 28% of U.S. adults own cryptocurrency, and a number just shy of 15% of young home buyers used crypto for down payments over the last 1 to 1.5 years. But they had to liquidate the cash flow, they had to sell the crypto, turn it into U.S. dollars, and then they can use it as down payment asset. The news that came out last week with Better Mortgage in a partnership with Coinbase and the acceptance from Fannie Mae to allow a second lien as that loan for using the asset of crypto for the down payment without paying margin, without getting margin calls, without paying any tax on that. What's your thoughts on that as far as is there any risk there? Number one. Number two, what did you think about the haircut that was being used at 40% to deal with the volatility? And what's your thought of this as a start and an entrance into a mortgage?
So I think that, first of all, Better Mortgage and Coinbase, those are two leading players in the field where this collaboration is going to show the innovation. It's going to create the adoption that we need. I also wholeheartedly believe that the 28% of Americans that own crypto, I think that number is actually quite larger. But people may not want to admit it for whatever reason. I think that we're seeing a shift away, call it whatever you want right now in our system, but we're seeing a shift away from this control that big banks have. People are realizing that they can now take control of their finances, their money, the decisions that are made. So I think that in this way, stablecoins themselves are one of the most widely adopted RWA tokens within the crypto industry. People are using them for pretty much everything. Now we're seeing wallets become credit cards. So we're having this effect of here's crypto, here's how you can use it. I think that having something like this be public and having the ability to pledge your crypto just opens up. I'm not even going to say it kind of is bridging both the Web 2 worlds with the Web 3 worlds of now you're not seen as you hold crypto, you're only transacting in crypto, but now you can actually do day-to-day things like get a mortgage. The haircut that you mentioned, I think given the dynamics of where we are within the market right now, I fully agree and understand with what that haircut is. I also think that when you are truly bridging two worlds, you have to be somewhat conservative. Digitally native assets are volatile. That is kind of like you talk to people about crypto, the number one term that comes out is volatility. So I think that you don't want to have something like this. You don't want to launch a product such as this and get burnt. So this is our entryway into it. I'm happy to see it. I think that it's amazing. And it's just the start of, again, real estate mortgage is a perfect use case for blockchain. It just hasn't really had its mark. And I think that this is kind of the start of showing that it can make a bigger impact.
Hey, can we double click on the 40% haircut, and the fact the transaction impact of this being a second mortgage, a lien, right? From the buyer's perspective, if I'm pledging this asset, this crypto asset, right, and I'm getting 60% of the benefit of my asset, that how does in real terms, like I don't lose that 40%. I still own that 40%, or do I actually give up that 40% when I use this asset in this manner?
That great question, and they don't lose anything. It's strictly from an underwriting standpoint, and it's more of a let's dip our toe in the water as the housing industry. And I thought it was a conservative approach, which was smart, I would say. The one part I didn't fully understand was it's in a stable coin, which technically is 1-to-1 US dollar into a digital currency. So that to me would have a pair off of 1-to-1, but it doesn't in this either, which is good. I think coming out more conservative helps with lenders, regulators, investors to feel comfortable with where are the gotchas that we haven't thought about. We all know that it can drop 80%, right? I mean, so that 40% still is not fully covered of what we've seen historically. But the reasoning that I've talked to some of the crypto wallets and some of the exchanges, they said, we don't anticipate these wide drops like we've seen in the first 16 years. It's kind of evened out a little bit more, although right now, technically, the market is down and in a very extended bear market, which some look at it as a great buying opportunity, right? It's like anything else. Same thing with stocks and ETFs and mutual funds. So no, the consumer does not lose anything to that. It's just strictly from an underwriting standpoint. And that second mortgage really just fits into the automatic seller's guide of what Fannie Mae had anyway. It's just a different asset. Yeah. So nothing's really changed. It's just saying we're allowing another asset to be used for down payment, which personally I think is great. We do a lot of podcasts and panels, Courtney, and mortgage, and there's a couple topics that just keep getting talked about as homeownership affordability prohibitors. And some of it has been talked about ad nauseum. Some of it is moving and getting better. This is one I think really can move the needle as far as, there's this whole group. So I said 28%, which is the data that I found that own crypto. Mm-hmm. You're saying you think that's light. Okay.
Look, I could be totally wrong, but I do think that there's more people that hold crypto than 28%. But I'm also in this industry, so I'm a little bit biased here.
Yeah.
Exactly.
Yeah. Why do you think that, there was a question, I posted something on LinkedIn this morning and someone asked a question. I thought it was a great question. why do you think that there was a haircut on the USDC part of it, which is a stable coin one-to-one paired off and pegged with the US dollar? Was that just another,
Yeah.
you think that's just
Um,
another protection, or what do you think?
I just think that that's an extra layer of protection. I think that they obviously under the hood, like reading this article that comes out, I know from my experience that under the hood there were quite a few swaps and other players that were involved in this in terms of like custodying these assets. So we're reading a story when there was a lot of moving pieces on the back end. We dealt with this at Roofstock on Chain as well. I think that taking a conservative approach is, again, the better way to do it, as they're coming out like the first of many, and definitely don't want to get burnt on the first transaction.
Yeah. And what you've, I think, very clearly stated is, the internet was really the Web 2. We get into Web 3, which is owning the data itself and the metadata.
Yeah.
Internet for transferring the information, and the blockchain is for transferring the value.
Yes.
That's the only difference, right? The value is
Yeah.
transferred, the underneath part just not change. Yeah,
Yeah.
that's a good way to explain it. Also with the tokenization piece, whether it's the LLC or the special purpose vehicle set up for asset transfer, same thing with a crypto, right? With the coin, you can buy
Same
a piece
exact thing.
of your Coinbase and hold that as a wallet, or hold that in your wallet. Tell us a little bit about what you're doing today, where you're working, what are you focused on, and then how do you translate and transfer that into the U.S. housing?
Yeah, that's a good question. So right now I am working at a project. It's called Roa Finance. In crypto industry, we have this new, like, crypto industry has a lot of buzzwords, RWAs, stable coins. Right now there's one that's called vaults. So basically you have strategists or curators. They have a set of assets. And we see digitally native being permissionless assets, your Bitcoin, Ethereum, Solana, and then you have RWA tokens, which could be T-bills, ETFs, private credit, whatever it may be. So basically they curate a strategy. They have a name for them, curators. They curate strategies, they put them in a basket, and then they allow external parties to come and participate within this basket. So think of like a fund manager that is inviting people to come and participate in this strategy. So what we do at Roa is we basically add, I'm going to say logic, but also more so tooling that doesn't exist in vaults right now. So we are really trying to bridge the gap between TradFi and DeFi in terms of these tools. So decentralized finance and traditional finance. Think of it, you go onto your Chase app and you have all of these capabilities to do within your app. That doesn't exist for the most part in crypto, especially when you talk about like at a protocol level. So you have a lot of these vault infrastructure providers that have these strategies listed, but there's a lot of programmability that doesn't exist. So what Roa has done is done like enabled auto rebalancing, time-based, threshold-based triggers, auto execution levers. So there's a lot of just, quite frankly, automations that don't exist that we are bringing to the vaults. So we're in a very, I'm going to say, a very complementary space where we're not necessarily competing with anyone. We're giving extra tooling and extra logic to people, whether you're an asset issuer looking for additional distribution. So whether you have this, call it tokenized loans, and you're looking for distribution and looking for the liquidity, we provide that distribution layer, or you are a curator yourself looking to curate different strategies with different assets and can define the allocations, or you're looking to deploy capital on chain, Roa is where the strategies will live.
So it's not about replacing the system, it's about upgrading the rails. The asset doesn't change, the
Correct.
infrastructure around it does. So I tend to think about this less as a disruption and more as upgrading the rails, like I said, and credit risk
Correct.
doesn't change, but it's how we move the value and verify the ownership. So bringing this back to what's relevant to the audience, Brian, I'm thinking the mortgage compliance data set, or MCD, that MISMO has as a standardization for the industry is something that would sit on top of this layer that you're talking about, Courtney, right? Is that how you see that? Consider the MCD data set as the underlying data of the standardization that is needed by lenders in order to have a safe and sound loan that is then purchased by the capital markets.
Yeah, exactly. Exactly. You're not necessarily, you're giving above and beyond what already exists to enhance that feature.
If we fast forward a few years, what parts of tokenization and digital assets scale into housing, and where do you think the challenges may pop up?
That's such a loaded question as well. I think that
Pick one part and then
so I'm going to start with the challenges first, because I've seen this, like I know this all too well, and my LinkedIn feed and everything. So again, I'll go back to my original point of like tokenization does not create liquidity. And again, too, if you have an illiquid asset in Web 2, it's probably going to be an illiquid asset in Web 3. So the problem is we have a lot of these people that have a plot of land or just basically an illiquid asset that they can't, like capital markets will not touch this asset. They see crypto as a means to open up that market for them to have liquidity come into this asset. So you have a lot of these types of assets that just sit on the blockchain because it's a fragmented landscape where they think that tokenization creates a marketing funnel for them, that funds are just going to come running in for whatever reason. And that is, again, not the case. So I think that is one of the main issues that we have. People have to understand the tokenization. They have to understand the marketing and distribution of this asset. There's a lot of regulatory framework that's being worked on, which is a good thing, but it's still not completely buttoned up by means that people feel comfortable to do so. And one size fits all is definitely not the case here. So I think that is one of the biggest issues. I think that crypto is becoming institutionalized, and this is going to help a lot with the adoption of it, especially like Coinbase and Better Mortgage. Crypto is not seen as a scam. It's not seen as the wild, wild west anymore. People are actually paying attention to it and understanding that it's here to stay. So blockchain is infrastructure. Crypto is part of that infrastructure. Blockchain has the means to streamline, reduce intermediaries. Like it has the ability to enhance pretty much any and every single project out there. It's just by means of how you utilize it and how you speak to the product and how you tie it in. Again, I'm very bullish in terms of the real estate industry and the mortgage industry scaling with blockchain. I think we're coming to an age, especially with this Better and Coinbase moment, where again, crypto is showing up to the plate. I just don't want a massive moment for people to say, okay, that's what we thought it was, which is why I think they took the conservative approach.
Yeah.
But again, it's digital assets are here to stay. People are holding them. People are utilizing them. It still is a very nascent industry. There still is a lot of smoke and mirrors that we have to go through. But I think that, again, the technology itself is extremely powerful, and it's going to have to take legacy systems to understand this and adopt it for the worlds to come together and thrive.
Well said. Very, very helpful. Great conversation, Courtney. Thank you. And for our listeners out there, Courtney's joining us. She moved from the States over to Europe, a couple years ago?
Almost 2 years ago. Correct. Correct.
So,
yep.
Making it work around the world. So, Brian, any closing remarks as we conclude? It's a great conversation, Courtney. I definitely enjoyed your viewpoints on this, and I think very helpful in explaining.
Very helpful. I took some notes, so I've got some weekend reading ahead of me to try to catch up. But Courtney, I do appreciate you sharing your experience and expertise on this topic. Eric, of course, appreciate you for all kinds of things, but thanks for pinch hitting today and
Yeah.
driving this conversation. And most of all, thank you to the MISMO Mic'd Up audience. This is a special episode of our MISMO Mic'd Up podcast. I hope you enjoyed it, and feel free to drop some comments. We'll stream this, and wherever you pick up podcasts, you can add your notes and comments, and I'll put links back to Eric and to Courtney in the post. Courtney, Eric, thanks again for joining us today.
Yeah, thank you,
Thanks,
guys.
everyone.
Take care. Bye-bye.